Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 16th of March. I'm Daniel Lam, your host for the podcast. I want to take a look at the flow data in equities. Now, there are a few key points to highlight there. First of all, investors are still de-risking. Secondly, the most crowded trades remain at risk of a further unwind. And thirdly, focus will increasingly move towards regions and sectors that are likely to be better protected from any sustained commodities price shock and supply disruptions. In particular, I want to highlight US technology stocks. They have relatively light positioning versus history and offer quality exposure for the longer-term AI structural trend. Now, currently, markets are not expecting an end to the disruption in the Strait of Hormuz this month. European and EM markets are still following the 2022 Ukraine playbook, suggesting that people stay unconvinced that this conflict will be ending soon. Now, besides the disruption to oil supply, there are additional concerns around refined products, natural gas, fertilizer, metals, helium, and broader supply implications for manufacturing. These are not easily resolved by the release of strategic petroleum reserves. Hence, retail buying has taken a hit. There has been capitulation in the high conviction trades this year, such as long S&P 500, MSCI Korea, and silver. Institutional investors are staying subdued because of these geopolitical uncertainties. Speculative option flow activities have turned bearish for the first time since the Liberation Day last year. Now, there has been forced unwind of the most crowded trades. For example, long US cyclicality, short tech, short US dollar, and long bonds, due to the forced de-risking from long-short hedge funds, which close out the longs and cover the shorts. So therefore, cyclicals have been well under pressure. There has been unwind of the popular long stables versus software trade as well. But until there is genuine de-escalation, the year's prior winners in cyclicals are likely to underperform. On the other hand, technology, which has been suffering year to date, is likely to be firm and sought after. Now, coming into the end of February, there was elevated short interest in tech trades. Now, the relative consistency with which tech has outperformed the broader S&P 500 over the last 2 weeks, regardless of up and down moves in oil prices, likely reflects the light positioning setup and the sector rotation at play. Now, there are actually fundamental supports for parts of technology as well. Semiconductor chip supplies were already tight, and it could get worse. Liquid helium is a byproduct of natural gas and is an essential component in semiconductor manufacturing. So any sustained shortages may see GPU and memory chip prices going even higher. So our recommendation would be to be adding to the semiconductor segment of technology at this moment in time and also on dips. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.